purpose of this video is to talk about accounts receivables, and more specifically the issues related to valuation of receivables. So first thing I want to distinguish here is the difference between trade and non-trade receivables. So in general, when we have these discussions of valuation, it applies to all receivables, but for the most part we're dealing with trade receivables. These are the receivables of the operating activities of the business, whereas the non-trade are just rare receivables, like when you make an advance to an employee. In other words, you lend money or give money ahead of time to an employee. Receivables dealing with interest or dividends. These are not your everyday receivables, and as such we call them non-trade receivables. But for the most part, the company has material amounts generally of accounts receivable and notes receivables dealing with the operating activities or the trade activities. So I'm going to discuss three items here that affect valuation of receivables. The first one is how to deal with discounts and their effect on the valuation of receivables. Second one is the length of time between the point of sale and the due date of that receivable, the maturity date. So depending on the length of time between those two dates, the valuation of the receivable can change. And then lastly, the issue of uncollectible accounts. So how do we deal with the accounts receivable that eventually become uncollectible, that they're not paid? Those things will also affect the valuation of the receivable account. So notice what I'm saying here, big picture. Big picture is I have three items that affect the valuation of your accounts receivable. These are the three items. And as I am affecting the valuation of that balance sheet account, what you'll see is that also indirectly affects income statement accounts, whether that be a revenue or an expense. So the idea here is that by us being able to correctly value the receivable, we're also correctly valuing the revenues and the expenses related to those receivables. So let me give you an example here. Let's start with discounts, how we deal with discounts. The first type of discounts that we may encounter are what are called trade discounts. And these are adjustments to prices that the actual manufacturer or the original seller does in the process of selling their item. So normally the way we deal with trade discounts is that we technically don't deal with them, because it might be that an item in the past sold for $500 and we used to buy it at $500. And all of a sudden the manufacturer decides to issue a trade discount of $50 for any new purchases. So at that point, we're simply going to be buying it for the difference, 500 minus 50, which would be 450. So in essence, we would record 450 in our books as the purchase, okay? Or as the sale for that matter. In this case, since we're talking about receivables, we're talking about the sales themselves. So when we decide to give that $50 discount, then we would simply record the sale and the corresponding receivable for $450. We don't deal with the $50 discount. That's a trade discount. Now, don't mix those up with cash discounts, okay? So the cash discount is one where we as the seller would like to offer an incentive to our customers to pay those receivables early. And whatever that amount may be, we need to account for that, okay? Whether the customer takes that discount or not. So two methods that can be used, and it doesn't matter which one a company uses, okay? You could use the gross method approach or the net method approach. Either one will give you the same amount of accounts receivable at the end, and also the same amount of revenue at the end. Okay, so let's look at the gross method, for example. Under the gross method, I don't account for the discount up front. I wait until something occurs, whether the customer pays me within the discount or not. So for example, I assume I have a sale that is for $2,000. So I increase my accounts receivable for 2,000, and I have revenue of $2,000 as well. I keep it at the gross amount. I'm offering the client, the customer, a $40 discount, and that's what this is right here. Later on, I'll explain it. I'm offering them a $40 discount if they pay me within the discount period. So if they do not pay me within the discount period, then all we do is reverse this receivable, because that asset is removed from the books, and then we collect the 2,000, so we debit or increase cash for 2,000. That's the scenario where the client does not pay within the discount period. What's the other thing that could happen? That's why I have this OR here. If they pay us within the discount period, then at that point we're not going to receive $2,000 in cash. We're only going to get $1,960 in cash from that client. So same thing, we'll remove the accounts receivable, we'll deposit or account for the $1,960 of cash that we receive, and then the difference now is sales discount. Okay, and what this sales discount is doing is that it's acting to reduce the revenue. So this account right here is a contra revenue, because as you prepare your income statement, you're going to have net revenue of $1,960, or if you wanted to show it as revenue of 2,000 minus sales discounts of 40, that's still 1,960. Okay, so that's the first approach here under the gross method, where we basically don't account for the discount until the end of the process if we need to. Notice that if the client does not pay with a discount, then we don't even have to deal with accounting for the discount. The other method is the net method. So under the net method, what you assume, or you choose this method because maybe most of your customers do take advantage of the discounts, okay? And you choose to use this method for simplicity purposes. In other words, if most customers take the discount, they might as well just write it at the amount that it's going to be worth. So this will, you'll debit $1,960 for AR, accounts receivable, and you'll recognize only $1,960 for revenue. You take the discount out ahead of time. If that customer pays within the discount period, then the reversal of the journal entry is done. Basically, we remove the accounts receivable for $1,960 and we debit the cash that we receive. Or if the customer fails to pay within the discount period, then we record the whole full $2,000 of cash. We remove the AR for the original amount of $1,960, but now we use this account called sales discounts forfeited as a credit. And be very careful, don't mix sales discounts with sales discounts forfeited. These are two different things. This is a revenue. In other words, when we first recorded the revenue of $1,960, if the customer does not pay within the discount period, then we're short $40 of revenue. So we got to add that as an extra revenue if they don't pay within the discount period. So this here, sales discounts forfeited, is a revenue account. Whereas under the gross method, if you have to use this sales discounts, this is a contra revenue account. Okay, they're the opposite. In any case, the idea is this: throughout this process, no matter whether you use the gross method or the net method, your accounts receivable value will be correct, because it's either going to be, or the revenue, more specific, is going to be correct. You're either going to have to end up reducing the revenue, like we did right here, or you might have to increase the revenue, okay? Now, at the end of the day, the accounts receivable is also going to be taken out for the full amount. And one could argue that if you record the AR at the $2,000 and the customers later pay you within the discount period, you could argue that during that time, the accounts receivable technically was overstated, right? And that's true, but these are things that we cannot control. So we accept that level of imprecision, and these are short periods of time, anyways, right? So it doesn't matter that within 10 days usually is what you get a discount or something like that. So maybe for those 10 days it is overstated if they do take the discount, but after those 10 days, you're still going to remove the full amount. So keep in mind that the topic here is valuation of the accounts receivable, right? And by having the correct value of accounts receivable, we're also getting to the correct value of revenue. Whereas it started here as 2,000, if they do take the discount, then that's overstated. So by doing this, we're reducing that revenue to the correct amount. Okay? And we may not appreciate that. You can think of these things as just two methods to be used, but always keep in mind of the big picture. The big picture here is that we want to make sure that our assets are valued correctly and that our revenues in this case are correct as well. And these methods allow us to get to that, and that's what's important. Okay? The second item that affects valuation of your receivables is the length of time between the point of sale, the moment that this sale takes place, and when that invoice is due. So if for some reason the maturity, the time between the point of sale and the due date is less than 1 year, then we would consider this a short-term receivable and we would record it at the face amount. So in other words, whatever the sales value is, and normally we don't give this thought. If we sell something for $1,000 and it's due in 6 months, then it goes in the books as a receivable of $1,000, right? The sale is for $1,000. And that is usually the way we think about it. But where it becomes a little bit, where we have to put a little bit more, where we have to be careful is if this is greater than 1 year, okay? If it is greater than 1 year, then we don't record that sale at the face amount. We need to record it at the present value of the future cash flows because we're taking into consideration the time value of money at this point. So that same sale for $1,000, if I'm going to receive payment for that sale in 2 years, let's say, then at that point I will not record the sale for $1,000. Instead, I have to compute a present value based on some interest rate, discounted, and what will go on my books is going to be less than $1,000. It'll be the present value of that $1,000. So that's very important because if it's short-term, face amount, but if it's long-term receivable, then at that point we need to do an estimation of present value. And both of these things can affect the valuation of the receivable. And indirectly, the valuation of the revenue, right, for the sale amount. All right, so the last thing that I want to discuss here is how we deal with uncollectible accounts, uncollectible receivables. And again, this is an issue that affects your receivable because you may have to reduce the value of the receivables for the uncollectible amounts. Couple of methods that we can use. We can use the direct write-off method, and this is a possibility under GAAP if you have immaterial amounts of accounts receivable. In other words, small amounts of accounts receivable. They're not significant. And the way we will do it here is you record a sale whenever it occurs, just like we did over here, right? Whether you're using gross or net method, that doesn't matter. And then you don't write off an account at all until later when you find out that that person is, or that client is not going to pay you. And then at that point, you write off, or in other words, you credit the AR to remove it, and then you debit some loss, some expense to write it off because it became worthless. So the act of actually removing an asset, in other words, crediting that AR and then debiting a loss, that's a write-off. Okay, so we're going to directly write it off from the books and record a loss or an expense. And this is okay, again, if you have a small amount of receivables, but the issue that occurs with this method is that you may have a mismatch of revenues and expenses. And what I mean by that is, let's say you sold this item in Q1 of the year. Okay, so this was sold in Q1. And then it's only in Q3 that we find out that we're going to write this off. So if you think about it, you have a revenue that is recorded in Q1 and then an expense for the write-off that is recorded in Q3. That is what we would consider a mismatch because you have revenues in one period that are not matched with the expenses of that same period. So because of that, most companies do not use the direct write-off method. Everybody is most likely using allowance method because it attempts to match revenues and expenses in the same period. And for GAAP purposes, that is important. So this is the preferred method. So what ends up happening is you'll have sales for a particular period, and for those sales of that period, we will make an attempt at estimating the amount that we think will go bad in the future. Now, that's not 100% precise, of course, because it's an estimate of what we think will go bad. But from the perspective of financial reporting, we think it's more important to at least have a methodology and attempt to come up with that estimate than to simply not have an approach and possibly have mismatch of revenues and expenses as occurs in the direct write-off method. Okay, so a couple methods that can be used to come up with this estimate, right, of what we think will go bad. A couple methods. One is the percentage of credit sales for the period, and I'll refer to this as the income statement approach because of the fact that we're estimating the amount that will go bad based on an income statement account called sales. And then another approach, and this is probably the most widely used, is a percentage of your receivables, okay? And not just the receivables, but aged receivables. So in other words, we're going to list all the accounts that we have, all the accounts receivable we have, and we're going to age it by different time periods between which ones are current, which ones are 0 to 30 days old or past due, 31 to 60, etc. So we'll come up with an aging of the receivables, and then we'll estimate what we think of will go bad out of those receivables. And obviously, the older a receivable is, the more likely it's going to go bad. So we put higher percentages to those. And this we call, or I call, the balance sheet approach. Okay, so let me show you how this works. If I do the income statement approach, okay, and based on my computation, which we're just going to take as a given here, but based on my computation of current sales, current credit sales times some percentage, I come up with $500. And I think this is what will go bad out of the current sales. In other words, I think this is the amount that I will not collect from those credit sales based on previous experience, based on current economic conditions, and many other factors. Now, since I'm using the income statement approach, I need to go and look at what's already in my income statement expense account for that same uncollectible calculation. So, for example, if I already have $300 in that account, because maybe I estimated earlier that period some other amounts, okay, and I have not closed the books, then I need to think about the fact that I want that balance to be 500. So if I want that balance to be 500, I need a journal entry to get me from 300 to 500. So that's where the journal entry itself is only going to be for a portion of the amount. And it's that portion that'll get me to the 500 of what I think is going to go bad for the whole period. So that's why you have here the expense being recorded for 200, and then the allowance for uncollectible accounts gets $200. Now normally, I put this here on purpose, but normally your expense accounts will have a 0 in it because each period you're closing this account. But it could be that we're re-estimating, and our re-estimate of that same period gave us a higher amount than what we already had done before. So because of that, we are adding an extra $200. But if you were to come up with this $500 using the income statement approach, and there's 0 balance in the uncollectible expense account, then your journal entry would be for the full 500. Okay? Or the other alternative, so ignore anything we did here, okay? And let's just think about maybe estimating it using the balance sheet approach. If we use the balance sheet approach, and my estimate of the amount that will go bad is $550, and this estimate is based on the aging of the receivables and applying some percentages to those receivables. If I come up with the estimate under the balance sheet approach of $550, then before I do the journal entry, I need to know what's in my balance sheet account. That's the allowance for uncollectible account. Okay, recall that, maybe I should refresh your memory here. Recall the allowance for uncollectible account is a contra accounts receivable account. It's always trying to reduce the accounts receivable. So if I want that account to have an ending balance of 550, I want this to be the case right here, 550, then I need to consider what's already in there. And for whatever reason, the allowance for uncollectible account has a debit balance of 250. This is not the normal balance. The normal balance will be credit. But maybe in the past, you've written off more accounts than you originally estimated for. So because of that, there's a negative balance or a debit balance in a FUA, which is not normal. But it can happen. This is, these are the kind of things that happen. So if we would like to go from a negative 250 to a credit of 550 or a positive 550, then at this point we need a journal entry for $800. And that's what this is right here. Okay? So in conclusion, many things that can affect the value of your accounts receivable. In here we talked about how discounts, and in particular cash discounts, can affect the valuation. How the maturity length, or the time between the point of sale and the due date, how that can affect the valuation of the receivable. And also how we deal with uncollectible accounts and how that as well can affect the valuation of your receivables. And as we affect the valuation of the receivables here, keep in mind that we're also affecting the revenue accounts, like in this case, and the expense accounts related to these revenues, like in this case. This concludes the video on valuation of receivables.